Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making them move, and what to expect for the future. Today is April the 4th, 2023. It is now 3:41 p.m. Central Time. We have a lot to take a look at. Home loan interest rates are actually improving today, and we are starting to win the battle with the 200-day moving average, and we're going to take a look at that in just a moment. But why is that? Again, why do home loan interest rates is something that we discuss here. Make sure that you do like, subscribe, and share because this is great information that you need to know each day. So, the reason that we believe home loan interest rates are improving at this point is because we think we're going to get a number on Friday from the Bureau of Labor Statistics talking about employment numbers that's going to show that employment and job growth is not as robust as it was in some previous reports. Now, why is it that we would want to see that? Because that is a reflection of inflation coming down. And this is how this works. So, when the economy is booming and inflation is going crazy, people are buying everything they can get their hands on. So, take for instance vehicles. All of a sudden, you see vehicles flying off the shelves and there's almost no inventory. So, what do you do when a lot of people want to buy a lot of cars? You have to build more cars. And in order to build more cars, you need more employees, you need more staff. Well, the same thing goes in reverse. When all of a sudden the Federal Reserve comes out and increases the federal funds rate, they're trying to squeeze the economy, they're trying to slow the economy. And if you remember in my reports months ago, they actually used the definition or the explanation of we want to cause pain to the economy, slowing it down. Well, they increase the federal funds rate, which increases the cost of money to both consumers and businesses. And that means that people just have less money to spend on a monthly basis. So a family might say, look, I was going to buy 10 items at the store, but I'm going to have to pull back just a little bit and I'm only going to buy 9. And then maybe a couple months later, they're only going to buy 8 of whatever those items are. So you're buying less than you were buying before because you don't have as much money. Maybe you don't buy that new car this year because you don't quite have the money that you had last year or the year before, or things have gotten more expensive. Other things have gotten more expensive to where you don't have that extra capital to go and buy a new vehicle. So all of a sudden, less people are buying new vehicles, which then allows inventory to begin to build. And when you have inventory and you don't have huge demand, you don't need as many employees. You don't need to build as many cars as you did maybe the year before. So you stop with all of the hiring, the excessive hiring that you were having to do previously, and eventually you even get to the point of layoffs. Okay, so as businesses expand and contract, so does their workforce. And that happens in almost all industries. And we're starting to see that more on a national and even global, in a global sphere. So we're starting to see it actually happen. So let's take a look over here quickly at this article. Job openings tumble below 10 million in February for the first time in nearly 2 years. Now that's a different report that's called the JOLTS report that comes out, but again, it's just one indicator of employment starting to come down. We think that's going to follow through, and the same situation is going to show on the big number, the big BLS report that's going to come out on Friday. And if you remember taking a look at our charts at how painful and how influential that report can be, when we had employment showing to be through the roof and much greater employment than we had expected in February of this year, interest rates shot up. Now, again, this is an inverse chart, which means when this goes down, home loan interest rates go up. In this span, from this point to this point, home loan interest rates went up almost a full percent. And that is what? From the 2nd to the 9th. Okay, so just over a month, interest rates went up a full percent, in some cases even higher in certain banks. Now, you can see that since this date of March 9th, we've been fighting our way back. We've been getting up, coming up, have a little bit of a bounce back and forth. Now look at the run that we've been on in the last week, a little bit longer than a week now, going up each day, breaking through the 200-day moving average, and now we are way above the 200-day moving average, convincingly above it. We are currently up 16 basis points, and being that it's 3:46 p.m., we only have 14 minutes left in the trading day for bonds and for the mortgage-backed securities. So we're up 16 basis points. We're down 8 on the 10-year Treasury, which again is following through very well from where we were yesterday. So this is what we wanted, and we discussed yesterday, was we wanted to see some follow through, and we wanted to see us remain above the 200-day moving average so that we can consider it a floor of support rather than a ceiling of resistance. I like what I'm seeing today. It looks like we may be able to close above the 200-day moving average now for the second day in a row. I like to see 3 days in a row. It's important to me to see 3 days in a row before I really consider that either moving average or Fibonacci level to be a true floor of support with below us. So let's take another quick look here at where home loan interest rates really are now with all of the improvements that we have seen on our charts here. Okay, we should see some pretty significant improvements to our actual home loan interest rates. So let's take a look here. Run the scenario for the Brent Bruce Daily, the very well qualified 30-year fixed conventional home loan, 800 FICO score, 25% down, kind of the best of the best. Now look, here we are. We're coming up with our top bank right now, Flagstar Bank, at 6.375 with a little bit of a credit, $508. Okay. Next bank down here, still 6. I got to go down to United Wholesale, 6.375 at a cost of $205. Okay. Now I'm going to open this up right quick here, show you the parameters to make sure that I am within compliance. Close this up. Let's open up United Wholesale, which we take a look at pretty much every day. Now let's take a look at the number we've been following, which is this 5.999 interest rate, currently costing 0.296, $1,066. Now, this is very close to par, and par is when it's no points. We are very close, but look at how long it has taken for us to move away from 6.5%. If you've been watching this daily, we've been talking about 6.5% for a long time, even with a lot of improvements to our mortgage-backed securities markets. And what does that tell you? Well, we talk about this regularly, that tells you that that bank, and again, understand, there is the mortgage-backed security market that is set by investors, their buying power, their demand. And then there are the mortgage banks, okay? So the mortgage banks do set their own interest rates. They don't have to pass through the exact changes that the market gives them. So for instance, if ABC Bank has tons of business and they're backed up and they really can't take any more volume, let's say they have all the loans that they can handle today and their interest rate is 6.5. One of the things that banks sometimes do is they jack their interest rate up. So maybe they make their interest rate 7 or 7.5% for no reason, not because of a market condition movement, but because they need to slow their volume of incoming loans. So they kind of turn that valve, slowing down the incoming loans. Now, I'm not saying that that's what is happening here today with United Wholesale and 11 Mortgage and these other banks, but I'm making an illustration for you to understand they set their own rates. They set the rates that they pass on to the consumers and the brokers. So for any reason, one of them might say, look, I like what the market's doing, but they have departments of people that are analyzing this information that work for them, both United Wholesale, 11 Mortgage, and Flagstar Bank, and all these other places. They have analysts that look at this information just like I do, and then they determine where they're going to set their pricing. So they're sitting here right now saying, where do we really think the employment numbers are going to come in? And they're doing their own research. They're doing their own analysis because they want to predict the market just like we do. They want to get in front of the market so that they don't end up pricing their business in a way that they end up losing money or making less profit than they want to. So if they say we always want to make 1% on the volume, and all of a sudden they make a bad move on how they price business, and the market comes in, all of a sudden the employment number comes in too high, CPI is different than expected, and the market moves too quickly for that bank to make their moves and their adjustments, they might only make 0.75% profit instead of 1 full percent profit, which is not what they want to do. So I'm bringing that all up to explain to you that when you take a look here at the charts, so we take a look at the pricing here, and we see that we've been at 6.5 for so many days, it's because the banks don't feel comfortable. They don't feel comfortable yet passing along the progress in the market because they're worried about it getting taken back quickly. So what we need is we need that employment number to come out. We need it to come out showing employment is not nearly as strong as it was back in the March reading of January's numbers. And we need to see it come out showing either job creation is tremendously slow, or, you know, at least come in much less strong with much less growth than that report that hurt us so bad. And I think that we'll be off to the races at that point. So that's what we're watching out for. Friday is going to be a big day, and we'll talk more about that later in the week. So once again, always make sure that you like, subscribe, and share. I know this is a lot of information, but a lot of data coming out today. I'll talk to you again tomorrow.